Welcome back, you legends. Dr. Cal here, and let's get right into this video. All three major indices closed in the red today. S&P 500 was down 0.88%, the NASDAQ was down 1.3%, and the Dow 0.8%. Now, jumping back into the S&P 500 map, we can clearly see defensive posturing today. We have healthcare slightly in the green, we have utilities slightly in the green, aerospace and defense, as well as consumer defensives, while energy and big cap tech, financials, and basic materials have all closed in the red. The best performing sector for the day was utilities, which in fact was the only sector that closed meaningfully in the green today. In the runner-up, we have industrials, real estate, and consumer defensives closing somewhat flat on the day. Leading the losers were basic materials, energy, communication services, cyclicals, and technology, which is really what you would expect from a defensive risk-off day. Now let's jump into the daily chart for the S&P 500. On the chart, we have another indecision candle right here. An indecision candle, guys, is a candle with a narrow body and relatively long wicks to either side, the upside and the downside. This basically tells us that market participants could not make up their minds on whether the stock market should go up or go down. This is off the heels of the PCE inflation print that came out today, which surprisingly actually came in below expectations. We have the core PCE came in month over month at 0.3%. Expectations were at 0.4%. Year over year came in at 4.7%. Expectations were at 4.8%. And then PCE inflation came in, the headline number, which includes energy and food, came in at 6.3%, while the forecast was at 6.7%. This is a chart of the PCE, and we can start seeing the beginnings of inflation topping out, possibly forming a top right around March. And the core PCE continues to go down. This is very good news because this is the preferred measure of inflation by the Fed. So future interest rate hikes will entirely depend on this figure, and if it continues to go down, it will give more reason for the Fed to perhaps ease off interest rate hikes, which could help the stock market catch its breath and perhaps see a nice little rally. Now let's jump into the NASDAQ. This is a daily chart of the Qs, the NASDAQ ETF. And same thing really, we have a narrow body candle with wicks going to either side. In fact, on the smaller time frames, we closed this gap right here. We filled the gap and then we ran back all the way up. On the 2-hour chart, the MACD still remains negative, while on the daily chart, momentum is still positive. Same thing on the SPY, momentum still remains positive on the daily chart and remains somewhat negative on the 2-hour chart. So it looks like the market is just coiling for a huge coming move, either to the upside or to the downside. Price action tomorrow on Friday as well as on Monday when the FOMC minutes come out. Tuesday, Monday is going to be off. We should see the market make a decision either to the upside or to the downside. So this could go either way, honestly. I believe the PCE figures were actually favorable to the market. So we could see some chop running into that July 5th date. This is, guys, where seasonality can give us an edge as traders. And right here at the end of June, we tend to see a bottoming process for the middle of the year during midterm election years. And then we see somewhat of a nice rally going into the middle of July, then another pullback, and then another rally going into the beginning of August. So it's possible to see some additional choppy trading for a couple of days until the market perhaps tests the bottom again and then make a divergence with a higher low on the MACD, and then perhaps we could see a rally from there. That's one scenario. Another scenario is that the market just continues to chop sideways and then make a decision either on Tuesday next week or on Wednesday. And a very interesting statistic, guys, is that shortened trading weeks with 4 trading days tend to be significantly more bullish than standard trading weeks. So as of right now, I am leaning more bullish. Now jumping into the daily chart of the Russell 2000, the Russell fared fairly well today, performed slightly better than the larger indices like the NASDAQ and the S&P 500. The Russell tends to be a barometer for the risk appetite for the market. So when the Russell 2000 outperforms the market, that's a really nice huge check mark for the market for the upside. So as long as the IWM continues to outperform the S&P 500, I would say that's a positive sign for the bulls. Same thing on the daily chart. We still have somewhat positive momentum, but now it's more neutral. It's just moving sideways. We pulled back off a critical zone at $177, and we still have that gap at 183 that we could see the market try to fill either going into next week or into the middle of July. Again, remember guys, this gap has not been filled either by the NASDAQ or the S&P 500. And on the S&P 500, it's sitting at $400, a really critical psychological level for the market. So it makes a lot of sense to see the market try and fill that gap again. Now let's take a look at the volatility index, the VIX, also known as the fear index. And on the smaller time frames, we remain in a bullish context. We are making higher highs and higher lows. So it's actually plausible to see the VIX spike to around 32, right around when the FOMC minutes drop. And that's when perhaps we will see the market test the lows again and form a divergence on the MACD. In my opinion, that'll be a nice signal to go long again on the market. Now let's jump into the daily chart for Nvidia. We're down on the day about 2.5 percentage points. Still somewhat of an indecision candle, but it's significantly weaker than the market. So even the NASDAQ and the S&P 500 haven't actually made a lower low. Nvidia has. And semiconductors in general, the semiconductor index has been significantly underperforming the broader tech sector. In my opinion, that just makes it more of a buying opportunity to load up on Nvidia. And it is clearly coiling for a huge move coming up. We're sitting at a critical zone right here. We went outside of this border of the larger channel. This channel goes all the way back, guys, to the middle of the previous decade, right here. Look at that. So Nvidia has been trading inside of this channel for over 7 years now, and I do not expect that to change. We're probably around a buying opportunity like we've seen back in 2018 and 2019, as well as the 2020 crash. So I still like Nvidia for the longer term. And again, I'll be looking at accumulating some Nvidia shares at these levels here. Jumping over to AMD, similar chart to Nvidia really. We are right at that southern border for the longer term channel. The channel for AMD goes all the way back to 2016, the same as Nvidia. And we've respected this channel, so I do not expect this to change really. Again, I'll be looking at accumulating some AMD shares. We have a nice divergence on the daily chart and the MACD right here. And divergences on AMD have played fairly well in the past. So I really like AMD at this mid-70s level. There's a lot of support here, guys. We've seen several major reactions, so this is major support for AMD. So much volume has been traded here. So I definitely expect AMD to hold this level for a while and start perpetuating to the upside. Now jumping into Tesla still looks good. We still have this divergence. We've been making higher lows on the daily chart. And price action has been contracting, getting ready for a major move, either a break to the upside or a break to the downside. So we'll keep an eye out on Tesla, and if the market starts to rally again, it might be a really good idea to get back into Tesla for a long play. Now let's take a look at Apple. Apple still looks decent here, guys. We have a really long rejection candle right here. It looks better than the major indices in my opinion. And we're still fairly close to this resistance line that goes all the way back into the beginning of April. So I like Apple here. Again, I'll be waiting to see the FOMC minutes come out next week on Tuesday. And I'll watch really closely how the market reacts to the FOMC minutes. Remember guys, in an environment like this with high volatility, try to react to the market. Do not try to predict the market. So if the FOMC minutes come out and you see bullish action from the market and a confirmation the following day, that's when I'll be looking at going back into a long position. Oh, I almost forgot to mention this, guys. I had a short position on the S&P 500, in fact, that I opened right here at the top of the screen candle, and I closed it today. I took profits today because when the market is indecisive and is making indecisive action, it's really not helpful to hold options, either call options or put options, because the decay on those options, the theta, will just eat into your capital. So I had a nice profit. I decided to take the profit, and it was a nice little trade. Now let's take a look at the 10-year yield. I think the 10-year yield is trying to tell us something again. Look at that. We had a high right here, and then we had a lower high with an indecision candle and an evening star pattern or a tombstone pattern. where we went up, sideways, and then we went down, and then we had a follow through day today. So this is very bearish for the 10-year yield, and it's actually very good for the stock market because higher yields tend to go in tandem with high inflation, high oil prices, all the horrible bad things that have been hurting the market. So this is a huge check mark for the stock market, specifically the technology name, the growth names. So it's looking good. Now let's take a look at energy. This is the XLE, the energy ETF. Again, we have somewhat of an indecision candle, but it looks significantly weaker than the rest of the market because the rejection occurred to the upside, and it was not a neutral rejection where we went up and then down and then settled in the middle. So in my opinion, this is more bearish, and it's very typical of how energy should trade around a declining yield. So in my opinion, energy still remains bearish, and this is looking a lot like a bear flag. A full measured move on this bear flag would probably take us all the way down to, oh look at that, the bottom of the channel. Isn't it beautiful? Isn't it just absolutely amazing when the stock market just gives you exactly what you're looking for? I mean, I drew this channel way back last year, and it looks like the market will probably attempt a summer rally, specifically technology and growth stocks, as I've said, and oil will likely cool down, energy stocks will likely cool down into the summer, and perhaps going into the back half of the year, we will see energy consolidate some more and perhaps regain its momentum. But for now, I'm out of energy. I don't intend to trade energy at the moment. I'm more interested in looking at opportunities in the tech sector. Now let's take a look at oil. This is crude oil, and again, look at this beautiful rejection candle right here. In the previous video, I was talking about how this is a very significant rejection candle because it occurred at the 50-period moving average for the daily chart, and it's rejected right at the middle of the Bollinger Band. So this is very typical of a dead cat bounce in a bearish context, where we retrace about half of the move that we saw to the downside. Look at that, right at that 0.786 Fibonacci, and then rejected all the way down to the 50% and to the 50% line. Very typical of a dead cat bounce. With yields calming down and inflation perhaps moderating, I could definitely see oil go back all the way down to about $100 a barrel right here. We've had several reactions here, guys. So a pullback here I would expect to be bought actually. So we'll see. A pullback in oil will perhaps give reprieve to the broader stock market, and as I said, technology and growth, as well as communication services. So broadly speaking, this is actually a positive development for the stock market. The last chart I have for you guys is for Bitcoin, and look at that. I left this bear flag from yesterday's video, and we broke down through it today. I expect to continue to see weakness from Bitcoin, and I expect Bitcoin to continue to underperform the broader market. So even if technology rallies, guys, I do not expect any meaningful rallies from Bitcoin, because as I explained in the previous video, we're now in the part of the halving cycle for Bitcoin where we see a very prolonged period of decline and consolidation that could last even a year. I'll be more interested in Bitcoin perhaps next year around March, April. Now let's take a final look at the economic events that we have planned for tomorrow and next week. Tomorrow we will have the S&P 500 Global US Manufacturing PMI. A decline in this figure would indicate that we are closer and closer to a recession. And we had the PMI, the Chicago PMI, come out earlier today, and it was 56, 2 points below expectations and 4 points below the previous reading. So it's very clear that growth in the economy is slowing down significantly. And keep in mind, guys, stagflation is when we have low growth and high inflation. But if inflation comes down with the growth, that'll be more akin to a run-of-the-mill recession. So that's very typical of recessions. We get a very strong spike in inflation towards the end of an economic expansion, and we see these huge rallies in commodities, oil, energy prices in general. And as growth in fact subsides and comes down, we see commodity prices and inflation come down as well. So the market action that we've seen the past couple of weeks is very typical of trading around recession fears. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye.